Hello, we're going to jump right into our lesson on the cost of capital in the CAPM and continue our section on capital budgeting. Our last lecture focused a lot on the role of financial managers and also market efficiency. The relevant materials for this week are going to come from chapter 9, focusing on the cost of capital. Our next lecture will focus on forecasting. So the relevant material from that will be chapter 2, which does a pretty good job of looking at financial statements, and then chapter 11, which does a pretty good job of introducing some of the forecasting topics that we'll build on. Let's revisit our present value equation. So what we notice in our present value equation is in the numerator, we've got our free cash flows. In the denominator, we've got our WACC, our weighted average cost of capital. Now that WACC can be affected by so many things: market interest rates, risk aversion, the firm's mix of debt and equity. Many things can affect the WACC. What makes this lecture different from our previous lectures is that instead of the discount rate being given to us, we're actually going to estimate it. The way that we're going to estimate it is with the CAPM. So our CAPM has basically three components. We've got our risk-free rate, we've got our beta, and we've got our market risk premium. And the way to think about the expected return for the security, for the firm, for anything, is that it does a pretty good job of telling us what we should expect if we were to hold the security. So if I'm investing $1 million in firm I for 1 year, and it has an expected return of 12%, then in a year, I would expect to get 1.12 million. A different way of thinking about that is if firm I promises to pay me 1.12 million next year, today, to me, that would be worth 1 million given the expected return of 12%, the discount rate of 12%. So our CAPM has a risk-free rate, a beta, and a market risk premium. And part of the intuition behind the CAPM that I'm sure you went into in your intro to finance course is that as an investor, I only want to be compensated for the type of risk that I can't diversify away from my systematic risk. And our measure of systematic risk under the CAPM is going to be beta, the covariance of the security with the market divided by the variance with the market. The higher the covariance with the market, i.e., the more that you move up and down with the market, the riskier you are, because you're not offering me protection against the changes in the market. So the first thing that we have is our risk-free rate. And in calculating our risk-free rate and choosing our risk-free rate, we're going to use US government bonds. Now, US government bonds come in many different maturities. And the reason why we think of them as a really good measure of the risk-free rate is because the US government can always print money. So the government can always pay back its IOU, i.e. the bond that you're borrowing. In reality, for practitioners, typically they'll use, oftentimes they will use a AAA rate because many firms wouldn't be able to access this risk-free rate. And what you'll notice is that that red line, the AAA rate, is consistently higher than the 10-year return for the US government bond. Now, just because the bond is risk-free doesn't mean that it's without risk. It's still risky. As an investor, if I'm holding a US government bond, I'm going to be worried about two things: inflation risk and interest rate risk. Inflation risk, because as we said, the US government can print money. So I'm worried that the actual bond itself will lose value because the dollars will fall in value because of inflation. I also worry about interest rate risk because if I'm holding a bond for a very long maturity, then between the time that I've held the bond and the time that the bond matures, interest rates could change and my bond might lose value. So what does that mean? It means that when you look at a yield curve, a yield is the promised rate of return for the government bond. So the yield curve is going to show you how those yields change as you look across maturities. What you'll notice is that for these government bonds that have a really short maturity, they have a smaller yield, and for the ones with a higher maturity, they have a much higher yield. Why? Well, as an investor, as we said, if I'm holding a bond with a really long maturity, I'm going to be worried a lot about inflation risk and a lot about interest rate risk. Take a look for yourself, and what you'll see is that for most time periods, if you follow the link here in the lecture, for most time periods, you'll observe this positive slope in the yield curve. There are periods when the yield curve flattens and even periods where it inverts. But instead of it having that positive slope, it has a negative slope. And those periods typically coincide with recessions or with market dislocations, with periods when investors are really, really worried about what's going to happen in the future, and they want a lot of compensation for holding something short term. Okay, so our solution when choosing the risk-free rate is going to be to find a maturity that matches the maturity of our project. If we've got a 1-year project, we want to use a 1-year government bond. If we've got a 10-year project, we want to use a 10-year government bond. So step one, we know how to do. We know how to find a US Treasury that has a maturity that matches the maturity of our project. Our next step is going to be in calculating and choosing the market risk premium. Our market risk premium is an expectation, meaning that on average, it's how we expect the market to perform above the risk-free security. Now, there are many ways to think about the market portfolio. It should be the evaluated portfolio of all securities that trade in the market, including international securities, real estate, anything. In our class, and for most applications of corporate finance, it's typically okay to use a proxy. And the proxy that we'll use in our class is the S&P 500. So what are we going to do? We're going to look at averages. Why? Because it's really tough to know an expectation what the market will do tomorrow, what the right market risk premium will be. So what we can do is look at past market risk premiums and use that average as a way of approximating. And when we look from 1926 to 2015, or more recently from 1962 to 2015, we'll notice that our market risk premium hovers around 5, 6, 7, 8%, depending on the subsample that we look at. Okay, so we know how to do step one. We know how to use a US government treasury with a maturity that matches the maturity of our project. We also know how to use a market risk premium. We can look at the performance of the S&P 500 or another proxy for the market relative to the risk-free rate over a long time period to get a good sense of what the average return for the market has been. The very last step is going to be to calculate our beta. And again, our beta is the covariance of the security with the market divided by the variance of the market. Typically, we can estimate beta running regressions. We can look at historical returns for stock I and historical returns for the market. We can look at the risk-free rate, and get excess returns for stock I and excess returns for the market, and then regress them. I'm uploading also an Excel file that hopefully can show you how to do this step by step if it's something you haven't done in a while in Excel. Okay. We may not always have historical returns. For example, I might represent a brand new project or a brand new firm without any return history. So what can we do instead? Instead, we can apply asset beta. And this is something that happens a lot in real life. Now, if we're looking to start a brand new project, we always want to make sure that the riskiness of the cash flows that we're discounting is reflective of the actual beta that we're using. That may sound kind of confusing, but an easy way to think about this is this quote here from the finance director, the CFO for Intel. We typically set the discount rate at the corporate level. We may use a different discount rate for mergers and acquisitions. The software industry is very different from the semiconductor industry and has different risk factors. So we want to take that into consideration when we set the hurdle rate. The hurdle rate is how managers will refer to the discount rate for their internal projects. Okay, how do we calculate an asset beta? Remember that your assets equal your debt plus your equity. Your asset beta is going to be a weighted average of the beta of your debt and the beta of your equity. How are we going to weight it? We're going to take the market value of your debt divided by the market value of your debt and equity and multiply that by the beta of your debt, and then do the same thing for your beta of your equity. The market value of your equity divided by the market value of your debt and equity multiplied by the beta of your equity. Market values. So the market value of your debt is going to be the number of your bonds outstanding multiplied by the market price per bond. And for the market value of your equity, we know it's the shares outstanding multiplied by the market price for your shares. Now, we're going to run regressions to estimate the beta of your equity. And again, We're going to look at the excess return for the security and the excess return for the market. How are we going to get the beta of your debt? Well, we're going to do the same thing. We're going to run regressions. And the beta of the debt is going to be very, very low in general compared to the beta of your equity. And we'll see this when we look at these examples. So here we've got the excess return for Cisco. So that's the return for Cisco minus the risk-free rate. And then we've got the excess return for the S&P 500. So that's the return for the S&P 500 minus the risk-free rate. So each of these dots is going to correspond to the return for Cisco on a day and then the return for the S&P 500 on a day. And when we estimate our beta, we're basically fitting a line where it's a regression line, it's a slope. We're trying to find the best fit line for the return of the S&P 500 and explaining the return of Cisco. Now, what you'll notice is that there are deviations from the point from the actual, we'll call this a realized return or the observed return, and the best fit line, the expected return. The distance between these things is basically the diversifiable risk. And the way that you estimate this line, the way you estimate any regression, is by assuming that these error terms, the difference between what you expect and what you observe, on average are going to cancel out to zero. If that sounds like a bunch of mumbo jumbo, don't worry. The big takeaway is that you can plot the excess return for the stock and the excess return for the market and estimate a regression line. And that slope of that regression line is going to tell you your beta. And what do I observe? Well, the beta lets me know that if the return for the S&P 500 is around 10%, then I can have a pretty good expectation of what the return for Cisco should be. And again, this is an expectation because what you see is that the actual return is different from the expected return. If you look at the beta for debt, what you'll notice is that as we go down into riskier and riskier forms of debt, you have a higher beta. As we look at debt that has a longer maturity, you have a higher beta. Hopefully that feels intuitive. As an investor, if I'm holding bonds that are really risky, they're going to move a lot with the market. And as an investor, if I'm holding bonds that mature in a very long time, then they're also going to have a higher co-movement with the market than a bond that matures in a year. Okay, calculating the betas. So in order to calculate the betas, we're going to have to consider using something forward-looking. So what's your target value of debt or your target value of equity if they differ from your current value of debt and your current value of equity? The other thing that I want to point out is that book and market values for debt are very similar when the debt is newly issued. That's going to be good for us because it means that we can look at relatively recently issued debt to get a good approximation. So we've got our beta of our assets equal to the weighted value of the beta of our debt and the beta of our equity. If we do some rearranging and we do some algebra, what we'll find is that the beta of our equity equals the beta of our assets plus the ratio of debt to equity multiplied by the beta of our assets minus the beta of our debt. So what is this telling us? This is telling us that when we invest in a stock, when we hold the equity of a firm, there are going to be two sources of risk. The first, the beta of the assets, is going to represent the risk contained in the firm's operations. The second term, the debt to equity ratio multiplied by the difference in the beta of the assets and the beta of the debt, is going to represent the financial risk. So if I'm investing in a stock of the firm with a higher level of debt, I'm going to be worried about the firm's financial risk. Okay. An additional comment is that in order to get our WACC, our weighted average cost of capital, we can perform that same operation. We can get the expected return for our debt from our CAPM and the expected return for our equity from our CAPM, and then take the weighted value of that based on the mix of debt and equity for the firm. If we're looking at our after-tax cost of capital, one of the things we want to be careful about is that because corporate debt has a tax advantage, we want to account for that. So we're going to look for the after-tax rate of our corporate debt. Okay, so we now have everything we need to calculate the expected return for security I, project I, any I that you can think of. We know how to find our risk-free rate. We're going to take the maturity of the treasury and match it. We also know how to find our market risk premium. We're going to use the average historical return for the S&P 500 or for a market portfolio over the risk-free rate. We know how to calculate our beta. We can run a regression if we have access to prices of the excess return for the stock minus the risk-free rate and the excess return for the market minus the risk-free rate, or we can use our asset beta. And we're almost always going to be using our asset beta because, again, our projects are going to be financed with debt and equity. Okay, example one. Your firm sells hardware and is considering starting up a software division. The beta of your firm equals 1.2. Based on an analysis of other software firms, you know the beta of software firms equals 1.5. Assume a risk-free rate of 3% and a market risk premium of 7%. What is the correct discount rate for the cash flows from this new division? To calculate the correct discount rate, we're going to apply the beta of what? Of the software firm. Hopefully you can see that and you can understand why that's intuitively making sense because it's a new division that you're launching into. Example two, you're the CFO of the computer company that's expanding into a new cell phone division. This project costs $80 million today and will produce expected cash flows of $15 million for the next 10 years. You have the following market information. You know the maturity and the yields on these different treasuries. You also know the historical market risk premium is 7%. And then you know the betas of bonds that are AAA and bonds that are BAA. Now, what you have access to is the information for a cell phone company that is going to be what you use to actually answer this question. So let me read it. You also have information about another cell phone company, company VZ. They've got 10,000 bonds outstanding, rated AAA, currently priced at $900 per bond. They've got 1 million shares outstanding, currently priced at $15 per share. The beta of the company's equity is 1.5. What is the correct discount rate you should use for your potential cell phone division? So in solving this problem, there's sort of two steps. The first step is to remember that we want to get our asset beta, and we want to use the asset beta of BZ. So we're going to solve for the asset beta of VZ because we have all the information on the firm's debt and equity structure. We also know the asset beta of debt, and we can apply the beta of the equity that's given to us. And then our next step, once we solve for that asset beta, is going to be to solve for the expected return under the CAPM. Okay. Question two, what is the NPV of this cell phone division, and should you make this investment? After we have the expected return for VZ, the proper discount rate, we can then take that discount rate and apply it to our project. So we're just going to set up the same standard annuity formula that we've been working with, and we're going to solve for an NPV. And hopefully you will observe that this is a project that you should take on because it has a positive NPV. Next week, we're going to look into forecasting cash flows. And as I said, I'm also going to upload an Excel file just in case it's been a while since you've ran regressions.